Thank you. I was asked to encourage the maximum of interactivity, so that means I should limit my introductory remarks also to the maximum. But let me start nevertheless by congratulating Fernando and the Financial Stability Institute for their 20th anniversary. I still remember 20 years ago I was heading a central bank who was struggling to get into the BIS, which was done some years later. But already at that time I very eagerly participated in some of the conferences organized by the FSI. And I would also start by recommending to everyone the reading of some of the FSI publications, especially also on the matters that we are discussing this morning. Especially there has been some interesting papers published on cybersecurity, supervisory technology, cloud computing, for example. But this morning we are trying to focus on three different subjects. I would say the first is that we try to agree and validate on the what are we talking about, the definition. What is this technological revolution about? Does it really artificial intelligence, machine learning, DLT, do they increase efficiencies, as is obvious at first sight? But if it does so, at what cost? And the cost as public sector representatives, I think we should look at society at large. And we would not only need to see what are the evidence for positive takeaways from these technological developments, for example, increased supply for services for consumers, maybe in some cases also increased access to new areas of finance, so financial inclusion. But on the other hand, even if we would see in theory that new technologies increase competition, increased competition means lower prices, more efficient services. But then it is entirely only a positive development. Are there not also risks that are associated with these new developments? Sometimes we hear that we are approaching the end of privacy, because in the future we will only have a world of Big Brother where all data will be collected, more efficiently collected, but also collected very often in the hands of a few players which do have access to private data, not only within their jurisdiction, but on a global level. Is that something we should look at? I think that will be part of our discussion. We also have to be mindful whether the new technologies would also raise questions of market integrity, for example, in relation with anti-money laundering, consumer protection, financial stability issues. So this is by and large, I would say, the areas we would focus on today. Now, as a first approach, I will ask the different panel members to start with in alphabetical order as they have been presented, to identify the disruption potential of the new developments and also tell us in a few minutes what trade-offs they see and above all what they would see as an appropriate regulatory as well as supervisory approach to these developments. So the number of risks and opportunities, what is the response? Should we only focus on risks as public sector representatives, or do we have a role to actively promote and support these innovative developments? I think that would be the first question we will have to ask. So I go in alphabetical order, first looking to Felix. How do you respond to such a question? 5 minutes, as I was told, everyone.
Thanks, Yves. First of all, let me join everybody, Fernando, for congratulating the FSI to its 20th birthday. I must say, however, when I celebrated my 20th birthday, sort of the party crowd looked slightly different, and I should say the gender balance was quite different as well. So maybe we can catch up for the 25th birthday next time, but thanks for having me. It's a pleasure to be here. Yves, big questions. And if I remember correctly, yesterday, where I took the privilege to listen to excellent panels already, I think there was not one panel, including Howard's speech we just heard a moment ago, where the matter of technology wasn't touched one way or the other. It does reflect the fact that indeed technological innovation and change in the financial services industry and obviously way beyond financial services is a really fundamental driver for change. And I think indeed we as financial regulators have to react to that in three different ways. First of all, I do believe we have the obligation to truly understand what's going on out there. We have to understand the strategic impact. We have to understand the scope of change happening out there, and of course reflect on implications with respect to financial regulation and supervision. The BaFin, as a major regulator, has established resources to do exactly that. It's quite a journey. It's never a done job. And then, of course, you get in touch with major issues like big data, artificial intelligence, with distributed ledger technologies, with all sorts of different issues, the whole fintech movement in a way, although that in itself has been changing quite a bit. So that in itself is a major task, which is performed by pretty much each and every financial regulator around the world, including all major international bodies involved with that. And do I believe changes are to be discussed? Yes, absolutely. In many cases, it's not obvious. In many cases, it will not be financial regulation in a narrow sense who can address the job. You pointed to data protection issues. You raised a question on the concept of privacy in a very general sense. Very good questions indeed, but very likely not to be addressed in isolation just by financial regulation. The second focus of what we need to do, obviously, is call it the dark side of digitalization. It's commonly called cyber risk or IT security matters. That, funny enough, logically speaking, is quite close to the heart of traditional supervision. It's a way of risk management discipline, although applied to a very new phenomenon. So we have to reinvent risk management practices with respect to IT security, and so we do. And again, that's something most national authorities, as well as the ECB and many international bodies, invest a lot of time in order to improve that. And that covers both supervisory expectations, which are very important to spell out in a new way as it's been done previously, as well as the issue of resiliency and last but not least, crisis management techniques once something went wrong. The difference between solving a problem within 2 hours versus 8 hours versus 24 hours may be the difference of something like $20 billion or euros or what have you, and we've seen that happening. And funny enough, just to address one common error in that field, as of today, the vast majority of IT security problems or incidents happening are not based on outside criminal activities, but the vast majority is based on simple negligence within financial organizations. So we should not get obsessed just on sort of the big criminal, which are, of course, a problem. So I'm not saying they don't exist, they are very important. But so far, I would give that difficult to find hard numbers, but anything between 2/3 and 75% of all incidents are rather driven by internal mishaps or mistakes or procedural problems. Now, the third issue, I think we'll come back to later in our discussion, of course, we have to focus on as public authorities is ourselves. we will have to change the way we interact with the industry. We will have to change how we do supervision. We will have to change how to perform our internal services. So we ourselves are not only subject but object to digital change and appliances of various types of new tools. And that's a quite exciting journey in itself, which of course we have started and many others have. I think, Yves, that's something we will address sometimes later throughout our discussion, so I will stop here. But to answer the specific question which you put forward, should we only focus on risk or should we get engaged in promoting innovation? That's a difficult question. The short answer is we should never lose sight of risk. It's a similar situation like the green financing panel we had yesterday. We should never promote green financing disregarding risk. I would say the same about digitalization. Any supervisor who loses sight of the notion of risk in that regard, I think, is losing his or her soul and should not be done. So does it mean we shouldn't do anything about it and supporting it? Of course not. We should not treat a young startup company like a major established bank, that's for sure. But should we give, in a very direct sense, preferential treatment to startups? I doubt it. And you may hear, I'm not a friend of the sandbox approach, although I do understand that many authorities do that. But to me, there are two red lines which should never be crossed as a supervisor. Number one, a supervisor should never have the discretion to disregard legal requirements which have been given to the supervisor by the legislator. That's red line number one. And red line number two is, if there is a bunch of startup companies, say, whatever, 20 or so, it should not be my discretion to just pick out 10 of them to let them enjoy some preferential treatment on my behalf as opposed to the other 10, which would not enjoy that sort of treatment. I would find that unequal treatment, and both red lines in my view. So if those two red lines are defining elements of a sandbox, I'm against it. If you can promote innovation and startup without crossing such two red lines, we can talk about it. Thanks, Yves.
Okay, thank you. Thank you, Felix. Sopnendu Mohanty has dedicated his whole life to innovation in the private sector first, but then also in the public sector. So he sees both sides, and from that point of view, I think he's also well placed to answer the question. But I think he is also able to tell us how the technology can also improve our way of going about. So sub-technology will be part of his introduction as well.
Thank you. Before I go to sub-tech, let me take some of this point which was raised on the whole, I think, the topic of friend versus foe. I think for large part of the fintech journey I have seen in the industry is in the friend bucket. Which started a bit of foe in the early part of the fintech journey. But if you look at last 3 years, almost 80% of fintech have pivoted to this idea of supporting financial sector in their own digitization journey. So that's a shift, and that's a positive, because they are there to help the banks and the insurance company to do their job in terms of digitizing the core infrastructure. What also happened is that there's a rise of so this fintech have got three characteristics, and you have to appreciate that. One is they start with customer problem. You'll ask any fintech founder, their starting point is about consumer. They're either solving a problem which they themselves faced, or they're solving a problem which they believe has to be solved. The second aspect of fintech is they operate on extremely smart technology. They know how to use technology in the most efficient way, in the most cost-effective way. And the third aspect is that they're very agile. They can shift very quickly based on consumer behavior, demand, and that's something works well for fintech. Now, can we take these three characteristics of fintech and apply it to the financial sector, which has largely not been successful on the three things? Their ability to serve consumer is quite limited. The use of technology by financial sector, I don't think we have a debate on that. It is quite way behind other sector. And third, the agility doesn't exist. So how do we marry these two together and make a better financial sector? That's the big question. And we are seeing the trend last 3 years that there is a clear evidence where banks which are willing to adopt fintech as part of their journey, they are adopting some of these practices and they're changing the core system. That leads to my third point around what is the core system transformation means. There are three layers to look at. Historically, banks and insurance company, asset management company use enterprise systems, highly closed loop, very hard to change, and there is a sense of belief that if you don't change, things are better. And also, the industry itself work that way. And if you look at if you look at the vintage of technology, financial sector holds the oldest vintage technology. And while we pay the largest number of bill to the tech companies, so we pay a lot of money, but we use old technology. A bit of irony there. So there's a shift of breaking this technology to what we call as a segregating the enterprise, the data from the enterprise to an abstract level, where the data can be piped out to third-party fintech, which can then use the same data to provide middle office functions, risk management functions, customer-facing functions, core back office function in a much, much simpler and much more innovative way. So there's a shift of architecture happening in that space. And then when it comes to public infrastructure, there's a rise of public good, things like eKYC, things like payment stack in India and also in Singapore. You can see large public infrastructure which are adopting this new technology to come as a public utility to the sector, and which is a good news because that also allows the sector to transform faster. So that's the broad technology shift in and the landscape as it stands today. Now, your question, particularly on the SupTech, I think there are two underlines there. SupTech actually it didn't start SupTech. It started with the RegTech because 3 years back there was this whole middle office transformation where a lot of fintech companies went into their space and started looking at, can we make reg reporting smarter? Can we make risk management using algorithm better? Can we do compliance monitoring? And they started unraveling a lot of data from the core system and they flipped it in a way to make the middle office function more efficient. That led to this, can we flip the data? Can we flip the same technology? Let supervisor use the same technology to do their job better. It's a very early stage. If you look at the history of SupTech and RegTech, is 3-year-old. But there are some opportunity we see, especially on the market monitoring side, the conduct monitoring side. Already examples exist where SupTech being used. But these are very early stage. There are two issues today in the whole SupTech space to be resolved. And they're kind of in two buckets. There's a technology risk or the issues, and there's an operational issues. What are the issues on technology side? First is the technology itself. It's going through its own maturity cycle. The algorithm is a black box, and still people are trying to grasp with the idea of machine learning. There's also data quality risk. Because a lot of the data which are trapped in the financial systems have to be unraveled in a way that they can be codified, they can be looked at, and they can be computed. There's the issue around data cleanup as the industry trying to grapple with the data issues. The third issue is the cybersecurity, because as this machine-readable data comes for SupTech to look at, there's a possibility of also getting a cyber hack or can be manipulated to get wrong outcome. And the fourth challenge is implementation, because these are technology which uses large data set. You need computing power. Now, are the supervisor ready to use cloud computing? Because without cloud computing, it's very hard to run a large data set. A lot of supervisors do struggle with the use of cloud in their daily work. And the operational risk are legal risk, because a lot of data comes with business sensitive data, commercial sensitive data, and it can get into this thin line of privacy, because you may, as a supervisor, don't like to look, or you may not have legal privileges to look at commercially sensitive data. So how do you segregate them? there are reputational risks because a lot of the data and the tools and the models can create unintended outcome from the softwares which they use to do all the subtech. So these are the broad challenges the supervisors have today. But having said that, this field is moving very, very rapidly with the better use of cloud, better use of data, much codified use of handling data. I think 2 to 3 years from now, we will see a good use of technology by the supervisor as they're capturing this new space of data-driven financial services.
Thank you for these optimistic remarks on the time span. We turn now to Ali Nickman, who is our youngest panelist, but he is also the only one from the private sector, pure. He is the founder and the CEO, as it was said, of an IT company that has a banking license as well. And I would like to read one sentence in his CV that says that at his company, everyone is convinced that the profit maximization strategy that traditional banks use does not contribute to a healthy financial system. Ali, this is a very surprising statement from the private sector.
Yes, that's true. Thank you. First of all, I would like to thank you all for having me here today. I do realize I'm a bit of the odd one out, and it's been absolutely fascinating in the past 24 hours to experience this meeting or this get-together. Second of all, as if it's not clear enough, I'm a total computer geek, and so I might be not as diplomatic as you're used to. You know, I hope in my utter humbleness, I apologize up front. Then before I answer your point, perhaps it's a good idea to shortly introduce bunq, because I imagine many of you don't know what it is. To give you a very short summary, bunq was founded in 2012 during and after the financial crisis to prove that a different business model with a different interaction with end users is also viably possible. Now, the cool thing is that the Dutch regulator, and often a lot has been said about regulators, but the Dutch regulator had the intelligence and also the bravery to take the steps necessary to allow us on the market. And so we became the first full bank to get a full banking license in 35 years, which was quite a thing, at least in the Netherlands. Now, that being said, I've listened to a lot of the panels over the past 24 hours, and it's just fascinating to see the set of problems you guys, because you mostly are guys, I have to say, are trying to tackle. And also from this first question, it almost seems to me as if regulators are in an identity crisis, because in this very rapidly changing world, you're tasked with basically the trust to keep the financial system safe, and basically you're amidst a storm and in a boat and it's going everywhere, and you're trying to keep all the plates and the glasses in the cupboard. That's the way I see it. I guess to give you a brief answer as to how I see things, I believe a comparison with a soccer match is perhaps relevant, where the regulator is the referee. And I think we need to have crystal clear, executable, which is also important, executable rules that are simple enough to understand by everyone. And then the regulator needs to be the referee, and then let the players play the game. If the referee starts to join the game or starts to adjust the rules mid-game, then as we all know from soccer, it's not necessarily the best game we're going to see. So although this answer might be a bit abstract, I do believe that it is at the core of what we are facing today, perhaps.
Ali, could I simply when you mention the regulator, you also mean the supervisor, or you make the difference between the two?
Both. For me, as as an outsider, the regulator, central banker, supervisor, it's all the same thing.
All the same stuff.
Everybody in a suit.
Thank you, Ali. I think that's food for thought, and coming from someone who is firmly established on his side of the fence. We are moving now in the introductory presentations to our last panelist, and I would like to apologize. She is the only female panelist. So it's not only about guys, it's also about girls today. And Ceyla, Pazarbasioglu, she has also a very big span. If I read her CV, it's her whole program on what she has responsibility, what we are going to discuss this morning. It's achieving inclusive growth, mobilize private investment, promoting access to finance, financial resilience, and so forth and so on, institution building. Ceyla, you have started also in the private sector. Then you moved to the IMF, where you were in charge of regulation as well in the capital markets department before you joined the World Bank, where you again focused on innovation. And now you have a much broader portfolio with all the different aspects I just mentioned. So I think you are uniquely placed as well to give a holistic approach to our discussion today. Ceyla, please.
Thank you very much. So first of all, good morning. It's a pleasure to be here. And again, thank you, Fernando, for inviting me, and many more 20 years of achievements for FSI. So I'd like to say that it's maybe not politically correct, but as women, we come to clean up. I've also done some cleanup in the banking sector in Turkey, and we are good at it. And if you look at some of the achievements in the past year in SSM, in several countries in the world, that we do come and clean up after big financial sector messes. And I think right now the key question in my mind is, should we only focus on risks, or should we actively promote financial innovation? I guess financial innovation is happening. No matter whether we facilitate it, whether we think about it or not, it's really happening. And it's happening very, very fast. You just need to, we were at the Singapore FinTech Festival in November, and you just had to look at the incredible services from anything from capital markets to payment services, transactions, and so on. And it's in many, many aspects of different types of services from all over the world, from Asia, China, and to remote corners of Africa. And that's where inclusive growth comes in, because it does have what was said at the beginning about really what Sopnendu said, finding solutions for customers, which seems to be what is driving fintech, is really critical to benefit those that are underserved, underbanked, underinsured, and there are billions of them, unfortunately. Our Findex numbers show some quite a bit of progress, but still there are many in the world which do not have an ID and which do not have any access to financial services. And it is really transforming when you go to some countries and see how having an ID, which is so natural to all of us, having a digital ID, having access to insurance, having access to contingent facilities, how that can really transform the lives of many and open up many opportunities for them to be included in global supply chains even. So it does offer a lot of opportunities. The question is, are these opportunities scalable? What is the role for public policy to make sure technology is inclusive? Because, I mean, we will discuss more, I hope, in this panel, and I would really like to hear more from Ali. But many times when I look at technology, it's really catered to the wealthy. When you look at these phones that we use or any of the devices we use, it's not really catering to those that are at the bottom of the pyramid. So I think I would like to think that whether technology can be truly inclusive or not is a policy choice. And it's a policy choice at the national level, at the regional level, and the global level. Because the rules of the game, as you said, will determine whether it's inclusive or not, both in terms of the participants in the technology space and in financial services, but also those that can access to those services. So I think what really we need to think through is how do we leverage these opportunities, but those that are most vulnerable, those that really need these services, are also very much those that are perhaps illiterate, innumerate, and do not have the capacity to assess the risk. So we have to be very careful as we think about inclusive technology and bringing technology and financial services to those that are vulnerable, to those who can really use these services, to make sure that they're also protected from the risks. We have partnered with our colleagues at the IMF, my former employee, and we put together what we call Bali FinTech Agenda. We announced it at the annual meetings just last October, which is basically a framework. It has 12 elements, broad sets of elements in 4 buckets in terms of the enabling environment, the financial sector policy framework, potential risks, as well as the international collaboration. And I would like to mention key elements that I think are important going forward to make sure that we do have the prerequisites at these different levels. One is fair and affordable access to foundational infrastructure, and that goes anything from ID to intranet access to agent networks, KYC utilities, credit infrastructure, and so on. How do we make sure that we have fair and affordable access? We have just launched, together with the African Union, the Digital Economy for Africa initiative. It's a very inspiring initiative. I do hope we make progress. And the mantra is by 2030, every African government, household, and firm are digitally enabled. And it's called moonshot by some at the bank, but we are putting in $25 billion of commitment as the bank, and we were really reaching out to others to see if we can focus on the foundations that are needed to deliver. Second is competition and contestability, because there are many, to ensure a level playing field for smaller firms, but also make sure that that we don't have the regulatory capture and powerful incumbents, which are vested interest in many of the countries that we work in, have that these don't pose challenges in terms of inclusion. And the third one is thinking through what are the appropriate policies, be it activity-based versus entity-based, and how do we ensure cross-border collaboration and coordination. And here, of course, BCBS has guidance, FSI has come with guidance, and so on. So I think it will be very important to learn from each other, to be humble, as many have said, but also try to come up with rules of the game that are flexible but do not change in mid-course, as was just mentioned.
Thank you very much. I hope these first presentations have already given food for thought and for the questions that we expect to come from the board further down the road. But before we go to the questions from the audience, I would like to ask now the audience to participate in a poll. And the question that will be asked is, should regulation on fintech take an activity-based as opposed to an entity-based approach? First, yes as a rule. Second, no as a rule. And as good central bankers, we offer a third option that is only as a complement, but not as a substitute for an entity-based approach. We have a strong majority who are of the conviction that we should have a regulatory or supervisory approach that is entity-based, activity-based as a rule. And that, of course, is different from what we are doing today. So it would mean a lot of work for all of us who are involved in this area. We should change the way how we are doing it, but this is coming from many people who are actively involved, so from supervisors themselves. It's a real desperate cry to the regulator to try to change the whole legislative approach. So the thousands and thousands of pages that we are used to apply every day ought to be thinned and changed from an entity-based approach to an activity-based approach. There is only 6% I see who disagree. As to the third, I deduct from the difference, that means 40% also seem to believe that we only have a complement. So that, of course, it's a little bit more vague a question. What is exactly complementary, and when the complementary becomes substitution, there can be soft edges in this respect as well. But nevertheless, it is interesting to see how this question over time has evolved. I have seen similar questions asked to audiences 1 or 2 years ago. By that time, the majority clearly was not in favor of having activity-based supervision as a rule. Maybe we can come back on this during the questions and answers. And I will now ask the second round of questions before handing over to the audience. And this time I will start with Ceyla. She has a very comprehensive approach of the matter. We are increasingly also seeing big tech firms which are offering range of financial services, that is from offering credit to payment intermediation. It is certain that in those countries which have a low penetration of bank services, this can support financial inclusion. But it is also true, as you have said yourself, that there are issues of the more fragile parts of the society being increasingly excluded from services. And there are also issues by big tech, which operate at the global level, having access to proprietary information of each individual in many jurisdictions. So questions of protecting consumers and protecting also national systems can create a tension. Ceyla, could you tell us to what extent you have thought or developed an answer to this apparently inherent tension?
So we have been thinking very hard about this, as I mentioned, because those that we are trying to include, those that are excluded, are also the most vulnerable because they are in remote corners of the world, most of them in subsistence farming, and they are also, as I said, illiterate and innumerate in many cases. So I think the key, and the question, yes, we have been thinking a lot and we don't have an answer yet because it is difficult. It requires coordination, cooperation at different levels. But there are two particular issues that are a worry. One is data becomes increasingly important, and it's the use of data in many different ways and coordination of data across different providers, which makes consumer very vulnerable because it's not clear how that data is used. It's not clear whether that could be discriminatory. What type of algorithms are used? What does that mean in terms of the information data that goes in determining how these services are provided? So there are lots of issues about data, not only the use of data, but the location of data, cross-border use of data, and so on. So I do think there's an urgent need to make more progress, and this has been very difficult because we know the political sensitivities about information sharing, but it's also very much needed. So the first issue is information, how that information is used, and whether it can be manipulated and lead to some sort of a bias. The second one is, again, related to information, but in terms of the services that are provided to users, and whether those clearly explain, provide the cost, what happens is, what are the risks of not being able to pay back, or what are the limitations in terms of functionality of these services. And we had done some surveys in countries like Kenya, where there is these what are called now nano loans, $2 loans. They are very important for many of the marketplace participants. They can use these $2 loans to actually do have access to supply chains. But we also found, as a result of this survey, is that 60% of these users of these $2 loans are actually non-performing. And most of the cases, they have to cut back on food and other important consumer goods in order to be able to pay for these loans. And many times it's because they are not targeted properly to the use. And we all know the risks we face with microcredit. So I think it's really very important to understand how these services are provided, what are the risks, and how can we provide the financial capacity building to those users so that they are not impacted by the risks of these services.
Thank you. I turn now to Sopnendu. And as I said, I will hound you on subtech, because to some extent, when regulators and supervisors rely on technology, it's obviously that they want to draw on economies of scale in order to be more efficient. But if you take, for example, know your customer or even anti-money laundering, you have to devise your machine learning according to your regulatory environment, which is not a global environment, but it's extremely diverse. And so how can you bridge this difference between technology, which only thrives on economies of scale, and the reality which thrives on the national jurisdiction?
I think it's a great question. But I thought last me to react on the first panel with the graph on the activity-based. Well, I'll come to the later. Let me respond to this question. Yes, actually, when I'll take an example on the AML CFT. I think that is a great example where we can deploy remarkable technology to do AML CFT monitoring. And the challenge, largely, as Ceyla was talking about, is the underlying data, which has got a cross-border implications, which has got where the resident, there are legal implications of how you look at this data, especially in the AML CFT context across multiple jurisdictions. But having said that, I'll argue against the hypothesis that having different standards at different jurisdiction is a limiting factor for subtech, because business rules can be kept separate from the computational rules and the data set and the computing resources. So we can abstract out the business rules for each jurisdiction, and they can run, while that's not ideal, but it doesn't really limit that the scale challenges what you just articulated. What we really require is a platform, because a lot of this data are huge data set. So will the regulators be open to put this data set on a cloud infrastructure? Or will they allow themselves to run algorithms on a cloud-based infrastructure, which sometimes gives them a bit of a scare on, because partly due to lack of understanding the cloud technology itself. So my belief is that this is not a limiting factor. What we need to do is to start codifying some piece of the regulations in way computers and programs read. And lack of codified regulation does hamper some of these subtech technologies. because sometimes they have to be a little gray in different market and how they interpret regulations in respective jurisdiction. Is there an evidence? We looked at many subtech and rector company that tend to operate in multiple jurisdictions without any constraint. They're very agile in fine-tuning their business model or business logics for respective market. So there's no clear evidence to say that having different business rules for different market will hamper the scale challenge. What we need to understand is that there's a collective wisdom to have scaled infrastructure. Is there a collective agreement of holding data, may not be in every jurisdiction, certain data can be consolidated and held in a shared infrastructure. I think those are the considerations which I will think more important compared to the business rule standardization.
Could I just follow up? In the area of cloud, you have an extremely high concentration of cloud service providers, and they are basically all in 2 home jurisdictions around the globe, the larger ones. Do you see that as an issue?
I think I think that the question should be clearly separated in 2 ways. One is who is the provider of the cloud infrastructure? When I say cloud, doesn't mean that it has to be this big 5, which occupies 60% of the cloud market. You can build a cloud infrastructure even outside those big 5. So that doesn't stop any one of us to build a cloud infrastructure for a country with any country with a scale. So that's keeping that aside. There's an issue around concentration risk around cloud, but that's in a way. Should not hamper, because most of the cloud providers, they do put segregated cloud infrastructure in multiple jurisdictions. There are clearly segregation of rules per certain country impose data residency clearly anchored within the respective country. If you see the underlying technology, there are enough response from the cloud operator to handle such concentration risk. Of course, the company itself can be a challenge if something goes wrong with that. Today morning, there's a news that Google Cloud went down because there was a malicious attack on Google Cloud to route all the transaction to China, Russia, and some of the Nigeria. So there are issues like that, but I would not worried about cloud concentration risk for now because we have enough alternate method to handle this.
Thank you. I will turn now to our football fan. Ali, when you say that you have a very high trust in the referee and in the regulator to set very clear rules, is that not a little bit easy? Because I think before you set rules, you must have a perfect understanding of where you want to go and where you believe we should go. And from that point of view, I asked you the same question as Felix, as a supervisor, and that is, do you have a clear view where the banking world is heading to, how it will evolve and how it should evolve?
Yeah, thank you. Well, to be completely honest and truthful, it depends largely on you, because there's so much that we could do and today with the technology we have, with the limitless possibilities of the internet. But the major problem is that all the rules and regulations make it extremely difficult to be truly innovative, because these all revolve around the current set and the current perception and idea of, well, in my case, what a bank should be, and therefore what the risks of a bank are, and therefore how they should be mitigated. And because all of these things are mandatory, it makes it very difficult to operate within this environment with a new notion of what a bank could be. So I do understand what you're asking me, but I do think that as long as, look, if we take back the example to the soccer thing, we know that we want a fair game, we know that we don't want anybody to get hurt, and we know that we want to have some spectacle, and then we let the game play. If we start regulating soccer the same way we are doing the banking sector, then that would mean that basically the rules would be such that, okay, you have 11 players, 4 need to be an attacker, 3 need to be midfield, 3 need to be for defense, or whatever you want to say. And all the teams have to play within these rules, and then we're surprised that, you know, how come all the teams play the same way? So I believe that there needs to be some room without substantial downward risk, you know, without big accidents to happen, for creativity to take place and shape the future. And of course, then it would also help, as you rightly said, if all the regulations are more harmonious across Europe at first, preferably the world, because the internet does not know any boundaries.
Thank you. Now I turn, of course, to Felix. Why do we have so many boundaries still within the regulations?
Well, let me come back to some of the key questions which you raised to several of the panelists. I'm a firm believer in the statement, same business, same risk, same rules. And maybe that's my déformation professionnelle as a regulator, but I think we should be obliged to hold that principle. And I don't think that does contradict with the level of flexibility and entrepreneurialism which we need to support startups. And I don't think it's fundamentally standing in the way to move on with a very important work Ceyla was talking about for inclusion and access to financial services in many of the emerging markets. I think you can reconcile both. It is very clear that existing financial regulation should never be misused as a barrier of entry to protect incumbents. That's for sure. But it shouldn't be there to hand out privileges to new players either. Now, I mean, let's start with a very simple question. Who is a new player? Is it just that romantic little startup starting in a garage somewhere and doing very helpful things for society? Or could it be Amazon Web Services, Google, and some of the very, very major so-called big techs as well? And the answer, of course, is both. I mean, is it a good startup if it's of an entrepreneurial startup as bunq, your company, is it? Or is it a bad startup if it's a subsidiary of a major bank? Question mark. Now, the seemingly simple answer on moving to an activity-based regulation as opposed to entity-based, I believe, Yves, because you made that point, that the third option could be slightly more opaque. I think exactly the other way around. It's the only way to provide a certain degree of reliability. That's why I'm very firmly in the camp of the third option. We should absolutely never, ever give up the entity-based approach. You know, if a regulator hears that a whole subset of financial services wants to be activities-based, in my ears, it sounds like a call for deregulation, and I will never, ever support that. However, I'm very much in the camp of saying we have to enlarge the way how we do regulation by means of activities-based. We had a very, very good reason to think that way last night before dinner, talking about shadow banks or NBFIs, I mean, depending on how you want to call it. And it could be another phenomenon which we are seeing already today and which I predict will be a much more common phenomenon in the next couple of years to come, which is, call it broken value chains, that a far larger part of value creation in the financial services industry, which was traditionally provided by one single bank, will be broken up to a whole range of players. And you could design it in a way, and it's already happening today, that just a small fronting piece is owned by a traditional financial service player, which we regulate or supervise, and the rest of it is done by a technology company. Now, having financial services as a regulated business for almost 100 years doesn't come without a reason. And I fail to see that the good reasons to regulate that business, which is about financial safety and health of millions and millions of people, will go away in the next 10 or 20 years just due to new technologies. I fundamentally don't believe that. So if that's true, then we have very good reasons to enlarge, and activity-based would be a very powerful tool to do that, to find our way as supervisors into such broken value chains where a very large portion is delivered by technology companies which are today outside of the realm of financial supervision. I would find that not to be acceptable going forward. So that needs to be revised. And indeed, not just for level playing field reasons, but for financial stability reasons as well. Take a very simple example. It's about cloud services, outsourcing services, or something. Today, financial supervisors may understand first-level outsourcing activities and concentration risk going along with it. But in many cases, you have no clue on second and third level outsourcing activities because you don't have direct access. So it could happen that on a second or third level of outsourcing, all comes into one or two major hands, and we don't even know it. That's completely unacceptable. So that already, and that's a very trivial example, just about plain vanilla outsourcing, which per se is not a new phenomenon at all. But the way it's been done, now it comes back to the point you just made, Yves, about a very major portion of cloud services being in the hands of very few players. I mean, at the very least, we need to know about it, we need to have access rights, we need to have the information rights, and we have to have some very basic abilities to do supervision for the sake of millions of people. So what I'm trying to say is I consider activities-based as a very important next steps into enlarging the toolbox of regulators and supervisors, but never, ever as a replacement.
Thank you, Felix. I think this was very clear. I think, you want to...
On the activity, I just have a small deviation from Felix's point. Well, I take an example in Singapore. We look at the payment service bill, which was previously a large designated single large overarching regulation. And we looked at, can we take a piece of that whole financial services and look at applying an activity-based regulation? As an example, the payment service. As you know, that the payment service has become very critical for the whole digital economy to move, and it is not a single payment provider which is providing different services. We broke the whole payment service act into 7 categories. And for each category, like acquirer, e-wallet operator, for each of the activity, we put a proportionate regulation as way to go with that particular activity. That allows a whole range of innovation to come in rather than putting a whole big chunk overarching regulation on anything called payment. So there is a space for some part of the existing activity which can be carved out to apply an activity-based regulation just for critical infrastructure which drives the whole digital economy shift. So that's my argument against, I don't recommend to have a full activity-based regulation for a deposit-taking institution, but you can take out pieces and see whether you can apply some of this activity-based thinking. So that's on the regulation or activity-based regulation. You had a strong remark on the whole sandbox. I think there's a definition issue in sandbox. What is the definition issue? People have really confused what sandbox as a single big magic box to do everything innovation. I think the sandbox has 2 clear definitions in my mind. There's a piece of sandbox which regulators are interested, called regulatory sandbox, and there's a piece of sandbox where the whole industry is engaged to experiment without breaking any regulatory mandate. The industry sandbox required, why? Because precisely to your point, a lot of these technologies are very new technology. There's unintended risk coming out of technology. So it is important for the industry to have an environment which allows them to give their data, test data, get the fintech company to participate, experiment different portion of their financial architecture, and see can they use some of this technology to dramatically change the infrastructure in line with the modern technology. So you need an industry public infrastructure sandbox to support that shift, and also creates a capacity building for the industry. It builds new talent. It helps us to appreciate the new technology better. I agree with you. The bar for a regulatory sandbox should be very high. I think there's no reason to provide regulatory exception for something which is not important for the sector. In case of Singapore, we looked at few candidates, almost 95% of the applicants did not make to regulatory sandbox because there's no reason to give them any exception. The only one who could make it was somebody who was looking for prudential regulatory temporary exception to prove a business model, but that too within a constraint defined by the central bank for a fixed period of time. But after that, done with the experiment, they must comply with the full regulation. So there's no real exception, but a period of 6 months of observation to see whether that business model operates. So that's my argument against sandbox, rather than not doing it completely.
Thanks for having this interesting dialogue, and I think I want to fuel a little bit the discussion. Also, what I take away from what we have heard so far is that everyone seems to agree that the technology is just an empowerment tool, which will not change our objectives and which will not fundamentally change our policies. But our policies has to use it to adapt, either to go faster or to enlarge their scope. And from that point of view, it is an important tool. When I speak also about how do you see the evolution of the banking system, the question is really, as you have just mentioned, Sopnendu, that maybe there are parts of banking, like payment systems, that needs to be treated slightly differently than part of a whole entity bank which does all the services. And maybe credit intermediation or wholesale banking, investment banking would still benefit from a more entity-based approach, while payment systems is moving closer to being commoditized, and from that point of view might have to see a slightly stronger activity-based. But these are only provocative questions. They are not meant to be proposals. I would also ask, when we see that the technology is encouraging accumulation of information, the question could be asked, do people get ever more information, and the incremental benefit, is it really helpful? It's like in the news. The more news we get, the less news we digest, and the more we're moving from reality to fake. Does this not also, it's being something, accumulation of information which above all benefits the supply side? Is it really also fully benefiting the demand side? I think that is also a question that could be asked. And then Felix, what you said, I fully understand your reaction, but it does not overcome the inherent tension that could arise between a microprudential approach and a macroprudential approach, between the entity-based supervision and a more systemic approach looking at financial stability as a whole. There could also be tension in between the two. But
Totally agree with you. If I may, that's precisely the reason why I do support the enlargement of an entity-based approach, exactly for the sake of systemic interdependencies, which I very much see happening, because I don't believe that a purely entity-based approach will suffice. It's not good enough. But if I may, just one sentence to the example on payment services, because Sopnendu mentioned it and you picked it up. Now, take Europe as an example. If the legislator, through the famous Payment Services Directive 2, has spoken and defined certain types of payment services, some of them being new services in a way, you know, like accounts, information services, or payment trigger services, which had not been as, well, maybe it's playing with words, whether we call that activity or entity, but if you're a company offering such services, and there are many of those now showing up at our doors, they are, by virtue of being an entity, to be licensed as a financial service company, not taking any deposits at all. So it's in the hand of the legislator to enlarge the scope of entity-based financial regulation, but I maintain the point, according to your very valid observation in my view, that it will still not be good enough. We have to supplement it with certain activities-based inroads into sort of a broader, more systemic view, and that's completely on your page.
Thank you, Felix. On my right side, do you want to come into the discussion, or we leave it to the general discussion afterwards?
Maybe a really short mark. I think the discussion is outdated. Because as we saw yesterday, it is implicitly we already have an activities-based approach because the non-regulated sphere is getting bigger and bigger and growing faster and faster. So the question should be, how fine-grained do we want to have the activities-based approach? From my, outside of view. Secondly, the way we approach things now is, if you ever travel to the Netherlands, I can advise you to bring an umbrella. And if you ever go to Brazil, bringing sunscreen is probably a good idea too. Now, it would be rather silly to ask of every traveler to always carry an umbrella and sunscreen in their bag. And it feels like that's what we are doing today.
Okay.
Okay, Ceyla.
Yeah. So I also think, in a little different way, but I also think we need to think broader in the sense that if you look at how situation has changed, developments have changed in the last 20 years, and whether the financial sector serves the real sector, right? We keep asking this question. And if you look at global value chains, how corporates finance themselves, how SMEs get financed, this has changed dramatically in the last 20 years. But I used to be a regulator at some stage in my life, but we seem to think still the same way. And I don't think we incorporate learnings from how the asset management industry is changing, how the corporate sector is financing itself, what the households are doing. So I took away one key lesson from yesterday's very good discussion, and that is, one, to be humble, and the other one is really the need for institutional strengthening for regulators, to have diversity of backgrounds, experience, and so on, to be able to understand what is changing, and therefore be more open-minded about how the business models are changing, how cross-subsidization is changing in the context of different financial institutions, so that we could actually come up with the right regulation where it's needed.
Thanks very much, I think, for reminding us that we are really in a knowledge-based industry that we are talking about, but also I think it's quite interesting for the discussion to take Ali's point of view that basically technology is an enabler for risk migration. And I will now ask the second question to the public. Do you think that cyber risk could one day be the cause of a bank's or an insurer's failure in the future? Two answers only, yes or no. That makes it much easier this time. I think that question was too easy, obviously. And we all agree, and we have not yet discussed cyber risk in more detail, and I think we have to do it. That is clearly what we are invited to have a further round on cyber risk, focused on cyber risk, but I don't want to conclude. I think this has been such a wealth of suggestions and convictions that have been brought about. Thank you to all the panelists as well, and I hand over to you.